My name is Andreas Höfner. I'm from Switzerland, Zurich. So I'm one of the guys based in this very nice country. I'm German and I'm the CEO of a hedge fund. The hedge fund name is Arbitrage Analytics, and we do provide quantitative trading solutions for institutional clients. And we do have a pretty high emphasis on cryptocurrencies and ICOs. The guys from the Blockchain Center asked me to give some view on, or put it other way around, a strategic perspective on ICOs or strategy and ICO. It's working. Which is bad, so the video is not working, but it doesn't matter. I hope most of you understand German, so this is actually from Swiss television. So they stated 3 days ago, Ice Age in Crypto Valley. So Crypto Valley, the picture is Zug. That's what we call in Switzerland Crypto Valley. And it's not completely clear if we now are in a situation where we are a little bit in rough waters. And so they were discussing massively what will happen now. The million-dollar question is, what is the role of Switzerland in the ICO industry? And as you can see, parts of the market are pretty skeptical. My view on that is still Switzerland is a dominant place for the ICO business and a very attractive place. And I will try to outline that later a little bit more in detail. My opinion is pretty clear. It's once in a lifetime opportunity to get really a startup off the ground. There are plenty of opportunities. The market has high liquidity and is a little bit actually over liquid. So it's, in my view, a very brilliant situation to get funding for a startup. We wanted to discuss here how could we do that via an ICO. I would like to summarize. So the whole class this week has the theme Crypto Startup School. And my assumption is a little bit, we are in a situation where you have a brilliant idea, your product is almost here, and the market has huge potential, and you simply are short of capital. So the question I want to answer is how and when to tap the ICO market and persuade the investor community to invest. And it's a very strategic view. Maybe we define strategy. Strategy is a word which is all over the place, and there is certainly not one clear definition. But maybe we define strategy as a set of activities leading to economic value. So the economic value is something an investor is looking for, which means someone will deploy capital to your ICO when you provide economic value and you provide growth potential. This is the video I would love to show. And this is something Paul highlighted. And what I really love, what's this? Yeah. What I really love in this video is the dynamics of the market. And it's quite amazing. So Paul did choose to give a very static view, but it's, what's it? Also, ja, nee, that's good son. It's okay. In principle, as you all know, the ICO market took off basically the last, let's say, 9 months. It's a brand new market, and it's very fast, which means whatever you want to do, you are late. You're not too late, but you're not an early adapter. You're here on a seminar 1 year too late, 2 years too late, 3 years too late. So the whole situation has changed dramatically. The market is now flooded with tons of ICOs, which means it's very difficult to differentiate in this market. How can you do that? It's almost impossible. Plus, it is cost intensive. I'm never sure why people state that an ICO is cheap. Community and campaign is expensive. You lose a lot of capital during that phase. It is not necessarily true that an ICO is cheap. It might be cheap because you don't pay fees in front or not enough fees, but in principle, your company loses capital. Simply, you lose during an ICO a lot of fees. My assumption is that you are interested to capitalize your company. So you should maximize any kind of revenues during the ICO process. That's okay. Sorry. No, it should work. Look, it's not working. Sorry for that. Okay. No, it's running. So what you see is the development of the ICO market. And that's now dynamic. It shows you the last 4 years. And the dots are ICOs tapping the market at different times. The color is based on a region. Blue is Europe. I believe green. What is green? Asia. And we have the North America with this light yellow. And you can see it takes years for the market to take off. And after a while, suddenly it really exploded. And I believe that this is one of the best videos you can watch simply to understand the dynamics of this market. And as a potential ICO, it's very difficult to attract the attention of the market. And it's getting very dynamic. And so I'm not sure, it's not the most actual one, so it doesn't matter, but the principle is pretty obvious. It's exploding. It has even more exploded the last 4 months. One of the findings you have is it is equally distributed between Europe, Asia, and North America. It's very different to the venture capital market. And you even have this pink, and pink is stateless, which is pretty strange. But they really don't know where to put it. When you compare that, currently the ICO market, rough figure, I would say something like 25 billion capital have been deployed to ICOs. That's pretty significant. When you compare that to the venture capital industry, it's significantly higher. These are now the real numbers. I wasn't sure about the numbers were here. This morning was 200 million, that was wrong. This is the US angel and seed activity. So that's for early startup, that's a number US firms deploying to early startups. An ICO is by definition an early startup. You can see it is about roughly $1 billion in a quarter. So 4 billion, 5 billion in a year. It's not big. It's actually pretty small. If you compare that to the ICO market is significantly bigger. If you take out the large ICOs, the whole picture changes. The large ICO like Telegram simply, change numbers significantly. But whatever you do, you should never underestimate the strength of the venture capital industry. They have huge potential, huge experience, and huge capital. And same is true in Europe. These are the numbers for Europe. Don't compare that. This is now the complete venture industry, also late venture. Late venture means you are already up and running. As an ICO, in most cases, you're a real startup. When you look at it, it is the angel seed, that's the middle blue line. This is what Europe is deploying to startups. Again, on a quarterly basis. You can see it's around 20% of the US, which means 250 million in a quarter. These numbers are not big. So if you want to chase capital and your intention is to raise real money, it will be difficult. It doesn't matter if you're in the ICO or in the VC business. And both sides could be important for you. So what is the conclusion? Capital is around. It doesn't matter if in an ICO or a VC, you as a startup will choose the way where you can raise the money. You're clearly opportunistic. People are prepared to invest in all industries, which means it doesn't matter where you're from. The ICO business is certainly much more software driven. We see wide range of industry. The market is extremely crowded, which means a lot of startups, a lot of investors, a lot of ICOs. And it's competitive on both sides. People want to deploy money, and there are plenty of startups looking for money. And don't forget, investors and startups are acting global. This is actually pretty new. 5 years ago, it wasn't the case. It was pretty local. Venture capital business has been a very local business. Silicon Valley invested in Silicon Valley. Those days are gone. This is all very supportive for any kind of business you want to start. What is the threat? Dominant players with large pool of capital. And don't forget the corporate venture guys, the Googles, Amazons, Apples, whatever. They have very deep pockets, and they are actually never included in those numbers. But they are really massively investing into any kind of technology venture. And the market attracts investor interest. And when a market has a high potential, it will attract a lot of money. I'm not sure if the number is correct, but Alibaba had something like 1,500 competitors. So why Alibaba did succeed, it may be pure luck. But if there is a huge potential in the market, there are a lot of people chasing the opportunity. And the competition acts again globally and very fast. So whatever kind of idea you have, at whatever situation you tap the market, people will be around very quickly to copy you. There is not a single idea which will not be copied when it's a reasonable potential. It is very difficult to adjust to that. So the competitive landscape is pretty complex. So what could you do? So the startup prototype strategic framework is this famous MVP. Before I read the book, for me MVP was the most valuable player in the basketball playoffs. It's now the most viable product, and I guess every one of you knew it. Actually, the idea behind this is pretty straightforward. Acquire your first client out of thin air. You don't have money. That's a book, and that's kind of a startup Bible. Does it help? Certainly. Does it really mean you can get to the market? Probably not. This is a methodology I found I really like, and which is used in the venture capital industry. It has been developed by a venture fund in the US, and those guys are called Wildcat. And so in principle, what they do is they, developed, enlarged, or put an extension to the MVP framework. So, and the principal concept is, from the idea to the product, is somewhat you probably, have to get one way, but the real issue is getting from the product to what they call traction. And traction means you have kind of a business. You have clients and you have revenues. Why do I introduce this framework? Probably the most important strategic decision you have when you are in a startup business is when to tap the market. Where and when. And when means, of course, timing in the market. So currently the ICO market has not necessarily supportive winds, which means it's a difficult environment, cryptocurrencies going south, it's tricky. So this is the market. You can't control the market. You can control your own decision. And there's a huge difference if you have zero turnover, some turnover, or growing turnover. The important part in this matrix is where to position in this traction gap. When do you go to the market? Valuation will change. My thinking is the ICO market will adopt the metrics from the VC industry sooner or later. There's no reason why there shouldn't be, VC industry is ages old, huge experience, existing and strong valuation models. So probability is very high that the ICO market will use the metrics. And the venture funds are investing in the ICO industry. So when do they invest? Go ahead.
So what would be the ideal timeline, or the normal timeline?
That's an arbitrary position. It depends. When you have no money, it's early. If you have capital, it's later. It depends how you judge. The only thing what I want to introduce is that's a critical decision. And this decision is a function of the market you can't control, and it's a function of where you are as a startup. And the theory that you enter a market with zero turnover and a funky white paper is probably gone. So that means somewhere in this green bar, you have to move to the market. We don't have to read that. So there's, I added some readings to my talk, and you can read it. I believe it's a pretty strong matrix, and it's more a strategic thinking. It's a strategic decision. The only thing you have to accept and to know is there's a market you can't control, and there's something you can control. And the question is, when do you tap the market? And it's a clear function of What's your capital? How is your business developing? Do you have other seed investments? We discussed in the previous talk, how do you, what do you do first? First ICO or first IPO? It's more the question is, when do you tap the venture capital industry and when do you tap the ICO market? Those markets are competitive. And as an entrepreneur, you should use it. You should understand how to position in that market. That's very critical. There are some findings around that. There's some statistical evidence. There is a MVR, that is a minimum viable revenue, which means that's a level where valuations change in the market. So people, investors, change their perception on the matrix, the economics you deliver. And the minimum valuable revenue and the minimum value traction is defined here. I have the data for software as a service companies. So it's about $2 million. So in principle, the finding in the venture capital industry is when you are in a startup, it's a venture, and you're in the software industry, your critical point is, from really starting the company, you should generate something like 2 million euros, dollars, whatever you want. If you don't do that, there's a high likelihood that you not succeed. If you arrive to that number, there's a high probability that you succeed. There's a lot of talk in the market about data mining. This is classical data mining. Enough evidence, enough data. So it simply tells there's 85% probability that you succeed if you make $2 million, euros, whatever you want, the first 2 years. You really take off when in the succeeding 4 to 6 quarters, you triple those revenue base. This is pure statistical evidence, and it's not, it's not data mining, it's not AI, it's HI, human intelligence. Okay? Go ahead.
Is ARRs, or is that the combined revenue over the 2 years?
Combined revenues. No? Combined revenues. And it's only statistical evidence. It's like real life. It doesn't really tell you something about your company. It could be totally different. But for the majority of the market, it tells you something. What is even more important, when you look at those numbers, these are critical inflection points for valuation changes. So in principle, if you look at valuation, the discount factor is, whatever your base case is, so the discount factor, the risk changes. When you have those revenues, you can maintain a business. If you don't have those revenues, you can't maintain a business. So why do I put that in this talk about strategy? Now, your question about when you tap the market in this green bar is a function of course, your capital base, your ability, but you have to accept that the market gives you a far higher valuation when you generate different revenues levels. This is something you have to take into account. Very simple. You could sell the company too cheap and you lose a lot of money. And that's probably the worst thing what could happen as an entrepreneur. You want to start up something, you go a high risk, you want to make money. So it's a very critical point for you, and it's a very critical point for the company because it changes the capital base and the opportunity set. More capital is simply more opportunity. So if you look at this, from the VC industry, roughly 70% of all startups do not return their investment. And There's no data for the ICO business. It's simply too new. And it's not about all the frauds in the ICO business. It's much more like there will be decent companies which have a real opportunity in the market. But it's far too early to tell what the matrix, the data around it is. So the best assumption is use data from the VC industry. And both markets are complementary. As a startup, you don't mind where you get the capital from. It's more a question of what kind of price you have to pay, and what is the fee load. So the $1 million questions is the $1 million question you ask, which is when to tap the market. And that's probably the most important strategic decision in the life of your company. And you should really think about it. And it's always sad if you have to rush, but in principle, think about something like the revenue potential explains a lot of, how investors approach you and value. That's it, basically. That's my talk. Thank you very much.